All right, why don't we go ahead and get started? So far, we have no technical difficulties like on Tuesday, so that's good. Today, we're going to talk about, is the market overvalued? And more specifically, if you think it is, what you can actually do about that. So hopefully it's a good topic. So couple housekeeping items first. Number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. For our friends in New Zealand, you can go to our website, morningstar.com.au, to find our FAP statement. And also, you should consult a financial advisor if you would like personal advice. All right, so is the market overvalued? Exciting day here in Sydney. It is the coldest day in 25 years, I just read. So that's exciting. Shawnee went home for lunch and told me that her face was still defrosting, which someone who grew up outside of New York seemed a little extreme, but I think it's cold as well. And here we go. All right. So let's spend a minute talking about price and value so we can understand the context to when we talk about if the market is overvalued. So we believe at Morningstar, wow, an early question. Oh, Vincent wants to know how the lunch auction is going. Yes, so for people here on Tuesday, there was a lunch auction. We were talking about how people pay a lot of money to go have lunch with Warren Buffett. And I don't remember what our highest bid was. Oh, my mother actually sent me a message afterwards and said she would pay $100 and 25 cents to have lunch with me. But since she's in Nashville in the US and is banned from coming here and I can't leave the country, we'll have to go with the second highest bidder. And speaking of lunch, I had a terrible lunch today. They forgot to give me soy sauce with my sushi, which was bad. After spending all day in meetings, except for my 9 a.m. meeting because Shawnee stood me up and did not show up to the meeting. Anyway, back to the webinar. She claims she feels bad about it. Back to the webinar. So price and value. So we at Morningstar and many investors believe that there can be pretty significant deviations between the value of something and the price. So the price is, of course, what we see quoted in every day as different shares and different indices move around. So that, of course, is the price. And what is the value? The value, of course, is the intrinsic value of what we're actually investing. So as investors, we want to value the companies that we buy and then compare it to the price and see if there's an opportunity to get something that is worth more than we're paying for it, just like anything else. So we have an example here of Telstra. This was taken a little while ago, so it's a screenshot from August, which I probably should have updated, but I didn't because I was having my terrible lunch. But our analysts calculate a value on securities. So in this case, the valuation on August 13th was $3.80 for Telstra, and it was trading at $3.12. So that's an example of a difference between price and value. So that is the context when we talk about, is the market overvalued? Okay, so we're going to go through some historical indicators, traditional historical indicators. And I said the disclaimer, Shawnee. Jeez, she doesn't show up to the meeting. She doesn't listen to the first part of the presentation. This is going very well. Let's talk about the price to earnings ratio. So before we get into some detail around this, what is the price to earnings ratio? Well, we're going to look at relative valuation techniques, and then we'll talk a little bit about other valuation techniques for the market. So price to earnings is simply what it says it is. As investors, what are we buying? Well, when we're buying a company, we are buying what that company actually does in the future. So what are the cash flows and earnings that that company is going to produce in the future. Now, price to earnings, we'll talk about why this can be a bad indicator, is simply saying how much are we paying for each dollar of earnings. So if the price to earnings of something share is 10, that means we are paying $10 as investors for a dollar of earnings. And since as investors we're interested in obviously what the companies, as partial owners of these companies, we're interested in what they make, we are very interested in what we're actually paying for those earnings. So a couple things before we get into where we are with PE. Price earnings is called the PE ratio. A couple things are important just for context. So number one, price earnings ratios are backward looking. So that means this is what the company has actually earned in the past. As a shareholder, I don't care about that. except for potentially a signal into what's going to happen in the future. Because all I care about as a shareholder every day is what's going to happen in the future for any company that I own. Now, there are price to earnings ratios. There are price to earnings ratios that do look at forward earnings. Oh, are people getting a blank screen and no audio? Wow. Okay, we had a comment from Rodney. So if anyone else is getting that, okay, people are saying it's okay. All right. Well, thank you. Anyway, so there are forward price to earnings ratios as well. So that's looking at forward earnings. Now, those are estimates, and we'll get into estimates in a second. But let's talk about where the price to earnings ratio is for the S&P 500. So these are the 500 largest stocks in the US. So as you can see from this little chart that I pulled, we are well above average. So on June 4th, a couple days ago, S&P 500 was 89% above average and at the second highest rate that it's ever been, except for, of course, the internet bubble. So not great place to look. So that's where we're sitting. So where are we actually? Historically, we've been between 7 and 22 for the S&P 500 PE ratio. Currently, we are close to 37. Now, the argument about why this doesn't matter is because this is looking at historic earnings. And as investors, obviously, we just care about the future. The other important thing to note, just to give this a little bit of context, is, of course, both these things can change. Both price and earnings can change. And if you think about last year, and generally we're looking at a price earnings ratio that's looking at the trailing 12 months. Last year, of course, there was a hopefully temporary dip in earnings for a lot of companies as there were a lot of restrictions related to COVID. So it's a very important thing to remember just for context. So that's something to look at for price to earnings. Let's go to the dividend yield, okay? So one thing that we can also consider is, hey, what's the dividend yield? So the yield of a share or an overall index is simply looking at what is paid out in dividends, and then it is dividing that by the share price. So historically, as you can see, the S&P, and this is only a 10-year look, but if we go back even further, there were higher dividends before. So historically, 3 to 7%. Currently, we're at 1.37. So you're not getting a lot of yield from the market these days. Let's look closer to home at what the dividend yield is. So in Australia, the historic average since 1980 has been over 4%, as you can see by this average line. Where are we right now? We're at 2.56%. Now, you generally get higher dividends in Australia because of the tax treatment around franking credits. They're more popular. But either way, in both markets, we are seeing dividend yields at lows. So that can be an indication, of course, that the market's overvalued. Now, one important thing to look at with dividends is dividends, of course, are a choice. They are a capital allocation decision by companies. You can pay out dividends, or you can do other stuff with them as a company. You could go out and pay down debt. You could buy back shares. You could invest in the business. You could just keep the cash on your balance sheet. So this is a decision made by companies, but still, the fact that we are at almost historic lows from a dividend yield perspective could indicate that the market is overvalued and that investors are paying a lot more for everything, for earnings, for cash flows in terms of dividends than they traditionally have. All right, let's look at the CAPE ratio, otherwise known as the Shiller PE. So I found this cool little chart today. Cool is pushing it, but still, what is the CAPE ratio? Well, one of the problems you have with earnings are, of course, that earnings fluctuate, and that at certain points of time, when you're looking at the PE ratio, things can be thrown off. So Robert Shiller, came up with this CAPE ratio, so the cyclically adjusted price to earnings ratio. And what that's looking at is that there are earnings fluctuations across the business cycle. So what are they doing here? Well, they are looking over a trailing 10 years and taking an inflation-adjusted earnings per share, of course, because you're looking back. And you can see here, we are at the second highest mark ever, 43.94. So this is a little bit behind this chart, but yeah, second highest ever after 2000. And according to this website, we are in an extreme bubble based on this level. So that is trying to take out effects, for example, from COVID. But what you can probably see here is because this is actually higher than the regular P, it's not really COVID that was driving it. It's valuation levels. All right, the next indicator, and we'll get into more interesting stuff after the indicators, unless you find this interesting. Market cap to GDP. So this is Buffett's favorite indicator, Warren Buffett. I don't know if you know other Buffetts, but just to be, clear. So what this looks at is it looks at the value of all the stocks that are trading, so the market cap at the end of the day, of all the different shares that are trading in a particular region or market or whatever, however we want to divide it. And then we look at the gross domestic product of the same region, market, or country. So what we're trying to get to here is we're trying to say, okay, the economy is made up of a lot of different things, right? So the economy, of course, includes public companies. It includes private companies that would not be part of this market cap. It includes government spending. So there's a lot of different components of an economy, but we're looking at what is the overall economic output of an economy and how does that compare to this market cap perspective. And pretty simple measure at the end of the day is that, what Buffett has said is that if the value of all the shares trading in a particular market equal the GDP, that's kind of fairly valued. Anything above that is overvalued. Anything below that is undervalued. So where are we? So we're going back to 1990 here. You can see that back in January, and for those of you that have been watching, the market's gone up since January. GDP has done well as well, but 82% in January versus the internet bubble, 71%. And then you can see here's the financial crisis when 46% undervalued. So this is another indicator suggesting that perhaps the market is overvalued. So what have we done? We've gone through 4 different indicators that all say the market's overvalued. So remember, we did price earnings, we did dividend yield, we did the CAPE ratio, we did market cap to GDP. So now what do we do? Well, first, a little bit of context to this. So we've talked about this a lot. Interest rates are also at a historic low. So if I was to come back and argue against everything I just said, I would say that the level of interest rates have increased valuation, and there's a number of reasons why that happens, which I can go into in a second, and that actually justifies what the market's trading at. So that when we're looking at historical data and comparing it to today, and that's a relative valuation technique, right? That's what we're trying to do, compare different points of data, so that when we do that, we are looking at a unprecedentedly low, I can't speak, interest rate right now, and that justifies the valuation, and that throws out all those historical comparisons. So that's the argument. I'm not saying I necessarily buy that argument, but we do have to remember that low interest rates make valuation levels go up. And I've said this a couple of times, but they do it for a couple reasons. Number one, there's simply the substitution effect that as investors, and as I'm sure you all face, you're not getting any money in cash, you're not getting any money from fixed interest, so people have gone further out that risk spectrum into shares to actually get some return. So that's one thing. And then there's simply the mathematics of how we value a share. So the way that we value shares is, as I said, what you care about as an investor is future cash flows that a company generates, because it's your company, you are an owner of that company. We discount those back to the present day because of, bless you will, because of the time value of money concept. And what do we discount it back with? Well, interest rates play a big role in that. So the lower that discount rate is, if we discount by less, the more those cash flows are worth and the more the company is worth. So that is the argument around why the market is not actually that overvalued. It's because of those levels of interest rates. All right, looks like we actually got. Yeah, so good question from Paul. So he goes, in that case, should you overlay interest rates into data and adjust up the baseline? Well, the problem that we have with this, and that I'm going to get into in a second, is that we don't actually fully know the exact impact that interest rates have. So valuation, while our analysts spend a lot of time obviously trying to calculate what is the appropriate valuation on every share that they cover, it is, yeah, a little bit science in terms of we are using math in here, but the other part is it is an art. As well. So what discount rates do you use? There's lots of different arguments to use different ones. It's not like we can go anywhere and see an exact valuation and understand that, okay, the market's definitely overvalued. A lot of this happens in hindsight, right? How do we know the market was overvalued in the dot-com crash? Well, we can look at what happened. Now, there are a lot of people arguing at that time, and we can go back and look at things like the PE ratio, like the CAPE ratio, everything else. We can go back and look if we go back a couple slides. So yeah, it's easy for us to sit here now and say the internet, during the internet bubble, the market was extremely overvalued. And what proved that is the giant falls. You know, the NASDAQ went down close to 80%, right? So that, quote unquote, proves that the market was overvalued. But at the time, if we were doing this back in 2000, at the time, I could sit here, and just like I said with interest rates, I could sit here and tell you all these reasons that people were using to justify valuation levels that had never been seen before. Namely, that the economy was completely different, the internet has, changed, productivity forever, all the stuff that you heard back there to justify share prices. I could have sat there and said the same thing, right? So we can't exactly overlay in any sort of like scientific way interest rates. What we can say is that interest rates have never been this low, and we are in sort of unprecedented territory. That was a good question. Okay, we'll just do this one now. From the anonymous attendee, my favorite attendee, says, is inflation also used to determine discounted cash flows? Okay, so let's talk about how inflation comes into play. So two different things. Number one, when you are estimating out those cash flows into the future, you need to have an opinion on inflation. And if you think about that as an equity analyst, and you don't even necessarily need a headline opinion on inflation, but you're building a model. So that model includes a couple different things. It includes revenue and it includes cost, both of which are impacted by inflation. So revenue, of course, is that if prices are going up and you as a company are able to pass those price increases on to consumers, then your revenue goes up. The other thing, of course, are inputs, the cost that goes in there. So you have to go out and buy raw materials or hire people or whatever goes into the inputs, depending upon the business that you have. That will also go up. So you have to have expectations for inflation that are built into those models. The other thing is the market's expectation for inflation is going to impact interest rates. So central banks, yes, they have done a lot to try to control interest rates, but at the end of the day, it's the market that controls interest rates. And as a fixed interest investor, you need to have an inflation opinion for you to make any sort of for you to go out there and make a fixed interest investment, right? So think about it. What happens when you buy a bond? You are buying fixed cash flows. So unlike a discounted cash flow model that we're using on equities, you are getting fixed cash flows. And those fixed cash flows are going to be worth less to you if there's inflation. So that's why interest rates go up when there's expectations around inflation. So it would be built into these models in both those ways. So one on the cash flows, and then two on the discount rate that we're using. If there's inflation, then you're going to use a higher interest rate. All right. So, well, we have lots of good questions. So maybe we'll pause here for questions before we get into what should we do about it? So another question from Paul. So he says, doesn't government stimulus play a big part in pushing up price, hence Buffett's indicator? Yeah. So that is true. So we've got a couple of things going on. We have an unprecedented low interest rate environment. And also if we look at the government intervention from the fiscal side, right? So monetary is the interest rates, and then fiscally is, of course, what governments are spending. If you look at what's happened, both in Australia. So number one, in response to COVID, there were direct payments to people, so JobKeeper, Job Seeker, so sort of direct injections of money into the economy. We're hearing a lot about infrastructure now. Same thing happening in the US. So there were direct payments to people, right? The U.S. Treasury just cut people's checks and sent them direct money to people. And there's also been huge investments in same kind of thing that we're talking about now, infrastructure, all this sorts of fiscal stimulus. So yeah, that's another indicator. But remember, Paul, that all of that goes into the economy, which increases GDP. So government spending is a key part of GDP. So that should push up GDP, and maybe that's a lagging indicator. Maybe we'll see that happen later on, and that will, of course, bring down that ratio. But yeah, we should see that impact on GDP. Okay, let's see. Yeah, so there's some good questions around what we should look at. We'll get into those in 1 second. One last point from Paul. He said, what about debt-fueled asset inflation, especially prior to the GFC? Yeah, I mean, we have seen that. What I'd say, especially as you said, prior to the GFC, what I'd say has happened recently now is people are actually deleveraging. So particularly individuals. So you've seen during COVID, when everyone was locked in their house, a lot of people made sensible decisions and actually paid off debt. As opposed to me, I just bought a lot of alcohol. So I think I just spent more. But when you get cases of wine delivered to your apartment every day, it's exciting. But most people make better choices than I do in every part of their lives. So yeah, I think that we've seen a lot of consumers that have actually deleveraged a little bit, which is a good thing. But yeah, any sort of inflation in things like houses and everything else is obviously feeding into a lot of this. Okay, so we've got a couple questions around. So Vincent and Norman both asked kind of similar questions. So Norman's asking, are benchmarks inflated by the dominance of the tech stocks in the index? Remove these, and what is the underlying numbers? And Vincent's asking kind of the same question. Do we need to look sector by sector? Is it the FANG stocks driving up the ratio, but other shares are reasonably priced? So yes, anytime that we are looking at an overall benchmark, we do need to think about what goes in there. So a perfect example, and many people think this is happening right now, perfect example is the internet bubble. Right? So at the end of the day, the interesting thing about the internet bubble is, yeah, the NASDAQ went down like 80%. NASDAQ was dominated by all of these obviously tech startups that were trading at these ridiculous valuation levels. S&P 500 also went down a lot. The Aussie market fell a lot. But if you look at what actually happened is when the bubble burst in 2000, so around March 2000, there were these steep falls, but value stocks actually performed pretty well. And I think in 2001, as the market was still falling, I think if you invested in a value index, that actually had a positive return. So there was this huge shift at that time from sort of growth into value, and a lot of it was, of course, caused by these enormous falls that you had in some of these shares. Now, there are people out there saying a similar thing is happening now. So once again, the index values are overinflated by a lot of growth tech stocks at the end of the day, all the stuff that we're seeing in all the headlines. So there is a thought out there that, potentially we could see the same thing happen. We could see overall indices fall, but still have large pockets of the market do pretty well, or at least fall a lot less. So yeah, I don't know, obviously, because I can't predict the future, but yeah, from a valuation perspective, certainly growth tech stocks have done well. They should do well with low interest rates. The question is, if interest rates start creeping up, what's going to happen? So yeah, those are good questions. Yeah, keep the questions coming. They're more exciting than my lunch. All right, so now we're going to look at the price to fair value. So as I said, when we're looking at all of these ratios, we are looking at historic numbers to compare them to. And we are in, as we said, kind of an unprecedented time with, number one, this government stimulus, number two, at the level of interest rates. So what our analysts try to do is our analysts spend their time doing share company by company that they cover. They are trying to go through and they are creating these discounted cash flow models. So projecting out cash flows into the future, discounting them back into the present day. So what we've done here, and so these are just screenshots from Morningstar Premium, is what we do is we take the individual shares that are made in a market and we roll that up to a country level. So what this means, just to be very clear, in Australia, every single share, so I think we cover, between Australia and New Zealand, I think we cover something like 220 different companies. We take the price to fair value of everything that our analysts cover, we roll it up to the country level. Now we do this is a very important note, and I'll tell you why in a second. We do this on an equal weighted basis. This is not how indices work. So an index is on a market cap weighted basis, which means that if a company is bigger, it has more of an influence over that index. So doing on an equal weighted basis is different. So all those questions that we had about are certain sectors dragging up the price to earnings ratio of the S&P 500, you would see that in those market cap weighted indexes. So it'd be exaggerated if the biggest stock, Apple, had a really high PE, and whatever the smallest stock, the 500, number 500 in the S&P 500, had a lower valuation level, the index is going to get dragged up by Apple. It would not happen for what we're doing because we are averaging everything. So we are taking Apple, the biggest company in the US, and we're taking the 500th biggest company in the US, and they both count equal to what we're doing. So just remember that. So what does this mean? Price to fair value. So we've calculated the fair value. Now we're looking at the price. By dividing the two, we know that 1, if it equals 1, that means we think it's fairly valued. Anything above 1 is something we think is overvalued. Anything below 1 is something we think is undervalued. So if we look at Australia right here, we believe it's 13% overvalued. New Zealand, 7% overvalued. Then we compare to where things were a year ago. So you can obviously see all the different countries. Now, a couple things that jump out at me at this is there are certainly pockets of value in here. So something interesting to look at. But I would also say that, our valuation levels here are certainly indicating that the market is overvalued, but not as overvalued as some of these other indicators would suggest. So that's sort of the takeaway for me from these numbers. But what you can do, of course, if you're on Premium, you can just click on the names and it'll go into all the shares that we cover in each one of these countries. Then you can see individually where there are potential values. All right, so the question, of course, is, what do you do about it? Should I sell, buy, or hold? Oh, we've got one more thing. See, I'm forgetting what I put in here. That is an indication of how hectic my day is. But Shani and I are going out for drinks after work. So she was really upset that we have a meeting till 4:30. She wanted to go out about halfway through this, but someone's got to work, right? All right, so one thing to think about, and I always try to say this to people, and people don't like this, but we have all been, anyone who has been an investor, we've all benefited from what's happened to the markets. It's like people that own their house, right? You own your house and you look at the crazy housing prices. Well, if you own your house, you benefit from it. If you don't own a house, like me, then you just kind of sit there and say, wow, this is terrible. But we've all, if we've been investors, we've benefited from the markets getting to overvalued, if that's what we believe. So what we're looking at here is we are looking at 10-year returns. So this is S&P 500. We're looking at 10-year returns, 30-year returns, and 50-year returns. Now, number one, we've just got the nominal annualized return. So this is just what you've gotten. So what you'll see is obviously these last 10 years have been very good, meaning you've gotten these returns. If we adjust this for inflation, you can see even more because inflation has been so low during this decade. We'll see what happens. But it's been so low compared to historic inflation numbers that the returns are even more pronounced. So you see, as we're moving up, so this of course includes the 70s, which were very, very high inflation from a decade perspective. As we move into shorter time frames, you'll see that these returns are historically been a lot higher. So this could account for the fact that that the market's overvalued because returns have been abnormally high. But remember, as an investor, you've benefited from this. So this gets into what should we do about it. All right. So this is, I don't think I proofread this slide. And I think I just put it together quickly this morning. I, wake up and think about this for some odd reason. All right. So there are kind of three options. What's with your facial expression? Are you looking at this slide? Is that the problem? Oh, Shani has not approved of the slide. Okay, there are three different options that you have as an investor if you believe the market's overvalued. The first option, of course, is do nothing. So you are an investor who is continuing to save and invest. You do nothing. You've got a plan. Hopefully, you just do the same thing that you've been doing. So this is Shani's approach. Put you on the spot here. Not enough on the spot to drag you out on camera, but something like that. So who may this be appropriate for? So once again, this obviously is not any sort of personal advice, but if you were earlier in your investing journey and you have lower account balances, meaning that the savings and investing that you're continually doing are meaningful in terms of that account balance, then this probably makes a lot of sense. So just keep putting money into the market. If it's overvalued, and we don't know if it is, we don't know what it's going to do in the future, then everything should be fine. Even if it does fall, because you have a relatively lower account balance, it'll be fine. You'll just keep putting money in, right? So, and the point of this is, so let's say you have $50,000 in your account and you're saving $10,000 a year. Right? So in that case, you're still saving a significant amount compared to your overall account balance. So, and this is probably the best advice for most people, maybe. What is the risk? Well, the risk is, and this particularly happens with new investors, is that when you see significant market drops, and generally, you're getting to the top of a bubble when there's a lot of new investors. And just so everyone's aware, there are a lot of new investors right now. So what is the problem? The problem is that the market crashes and then they all just give up. So we saw this, the most sort of, I think the biggest example of this was the Great Depression, where there was a whole generation of people who just would never invest in the stock market again because they saw what happened. So that's the first group. Shani is not happy with this slide. The second option is that you could make a tactical deviation from your, and this is terrible language, by the way, and I wrote it, but you can make a tactical deviation from your strategic asset allocation by keeping new savings in cash or taking income in cash, and basically save this cash for future opportunities. Okay, so what does this mean in English? It means that you may decide that your asset allocation, hopefully people have gone through a little bit of a plan and the whole goal planning that we talk about. You could decide that you want to put 90% of your assets in the stock market. Let's just keep this very simple, and have 10% in something else. Well, you could decide, because you think potentially the market's overvalued, that you're going to build up some more cash. And the way that you're going to do this is not by going in and selling everything you own. The way they're going to do this is all your savings are going to go into cash. You're not going to reinvest your dividends. You're just going to build up a little bit of a cushion. And the reason you're going to do this is because hopefully there's future opportunities if the market falls. Now, who may this be appropriate for? If you're more in the middle of your investing journey, you still have a while to go before retirement or whatever other goal you have, but you've benefited from these markets. So you've had a larger account balance going into what's happened in the last 10 years, and you've benefited from all of this excess return that's been built into the market. So what does that do? It should lower, remember when we did this on the portfolio construction edition of this, whatever this is, what we talked about is setting a required rate of return. That I have a goal, I need to earn a certain return to get my goal. Because the markets have performed so well, if we go back to this slide, because they performed so well, that should have lowered your required rate of return, meaning you don't have to take as much risk. Now, the reason I'm using these terrible finance terms of, well, I guess they're not finance terms. The reason I'm saying tactical, so tactical just means you still have a long-term asset allocation percentage that you want to get to, but you are deliberately, for the short term, moving away from that. And you're not moving away from it by selling, you're moving away from it with new savings and contributions you make. So what is the big risk? And this is where Shawnee thinks that I'm an idiot. I'm sure that this is market timing. At the end of the day. Now, this is not extreme market timing. Extreme market timing are people that put all of their money into equities and then take all their money out and put it into cash and then try to time the market and like catching the market at a high when they sell everything and at a low when they buy everything. Nobody can ever do that and it doesn't work. This isn't that because you're not selling any of your investments, but it's kind of market timing, right? You're making decisions on valuation levels and letting that influence how you invest. So that's the risk. All right, the last one. So you can change your long-term asset allocation. Instead of just doing it temporarily, you can change it. And you can do that by making a meaningful shift, meaning you are selling stuff, you are selling shares and moving them into a defensive asset class. So you're moving them into things like bonds or cash. So that is an option as well. And who may this be appropriate for? If you are close to retirement or you are in retirement, this is a potential option. Now, the reason you would want to do that is because in our other two examples, if we're looking at this as the first one being young people, the second one being middle-aged people, third one being people closer to retirement, the reason that you would do this is because a big market drop would impact you more than anyone else, right? It impacts you if you're close to retirement. This is called sequencing risk that we talk about a lot. It impacts you more if you're close to retirement. It certainly impacts you if you're in retirement, because if you have a set withdrawal rate that you're taking out of your account, then all of a sudden this is a problem because you're going to take out higher and higher amounts of, if you have set at retirement a 4% withdrawal rate from your account, and that's what you're using every year, that original number. So simple example, you have $100,000, you're taking out $4,000 a year, that's going to be, and that increases by inflation, that's the amount you're taking out. If the market goes down 50% and you're taking $4,000 out of a $50,000 account balance, all of a sudden that's a lot more. So you're taking out 8% of your money every year. So that is the big sequencing risk that people face around retirement, and particularly earlier in your retirement. Now, why would you do this? And this is where we get into this behavioral problem that I outlined over here. You could sit there and argue that you have benefited from, and if you're retiring now, you have benefited from literally a lifetime of very, very good returns on almost every single thing you've bought. So housing, the share market, everything else. So you benefited from these great returns. So you should have, if you set a goal, whenever you set your goal, you should have exceeded that goal in theory. Now, the problem why this doesn't actually work is because people just reset their goals and they sort of anchor onto certain things. Like people anchor onto account balances, right? So you sit there and the minute your account balance hits some sort of milestone, so let's say your account balance hits $100,000, all of a sudden in your head you think you have $100,000. And you can't sit there, and people don't logically sit there and say, oh, well, I should have had $80,000 if we had normal market returns. So that $20,000 is gravy. Like people don't ever think that way. So that's why this is very, very difficult. And it happens with everything, right? It's like lifestyle creep, you know? Same thing, right? Like all of a sudden you can't imagine going back to a lifestyle that you lived a long time ago and thought was fine. So that's my little rant about, I don't know what, lifestyle creep. But anyway, those are basically your options. Do nothing, kind of do something, or do something pretty significant by actually selling things. And what you can think about, I think at the end of the day, if you are in retirement, you can think about all you're doing is banking cash for next year or the year after's withdrawals from your account. So you're sort of pre-funding those future withdrawals. And even if the market continues to go up, you should be okay, right? You've just taken out the cash now rather than taking it out in the future. So hopefully it wouldn't have that big of an impact. All right, we've got a couple questions. which is good. Okay. I will not answer that question. Let's see. Okay, so where was I? Okay, so Vincent has a question. With all the additional money that went into the market during COVID, does this have any upward push on the market value? Yeah, of course, right? At the end of the day, the market is driven by supply and demand, right? So the more buyers in the market, the more money that flows into the market, of course, is going to drive the market up. Now, this stuff feeds on itself, right? Which is the problem. And that's good when it's going up, but it's also bad when it's going down. So, if you look at every market bubble in history that I talked about before, is you have this huge influx of new investors, kind of generally right towards the peak. So you start hearing about how much all your mates are making in the market. You read all these headlines about how great everything's doing, and you have a bunch of people pushing money into the market. And we've seen this with COVID, that a lot of the stimulus checks in the US, for example, went straight into the market. You've just had a bunch of new investors and a bunch of new money. The problem is that the same thing happens when the market starts falling. And it's kind of thinking about what is that inflection point, which does not have to be that big, right? So what is the inflection point that gets people worried and then they all run for the exits? And I think it's the point that I made on Tuesday, I believe, that one of the reasons that people get attacked so much for saying anything negative about the market in a bubble or any sort of run-up is because I think a lot of people know that's what is happening shouldn't be happening. Just like somebody put a comment in here about these meme stocks. I don't think that there are actually rational people that are creating these TikTok videos and putting stuff on Reddit about these meme stocks and how AMC, a movie theater company, is going to be the world's greatest company. It's a pretty terrible business. Especially since most people just sit at home and watch movies now. But it's a pretty terrible business. I don't think anybody thinks that this is rational. And the problem is when you have a bunch of people that are a little worried about what's happening, then it doesn't take much for them to panic and all start selling. So I think that is the concern. And you hear this stuff and you watch these things about these meme stocks that the anonymous attendee wrote. And what these meme stocks are, for anyone who doesn't know, GameStop was the big one. So at the end of the day, it is these Reddit boards and it's all these other, basically a lot of social media that's pushing these things up. You hear these people, first of all, they made it into like it's some sort of a crusade and this mantra of like, don't sell, don't sell, don't sell. Yeah, you're trying to convince other people not to cause this panic because that's what could happen. So yeah, I do think it's a lot of the COVID money that has gone in there. I just wonder how resilient that money is going to be if there's a big drop. Okay, so we have a question from Peter, which is an easy one. Will the recording be available to review again? It will. It will. So we will put this on Premium, on our Learn tab. We also, if you look up Morningstar Australia YouTube, there's a playlist that has these things on there. So you can go back and watch all of these things. Okay, so we've got a question from DP saying, what if you're retired but don't need income from your investments? Buy, sell, or accumulate cash. Okay, well that seems to be a really good position you're in, that you're retired and you don't need any of the money that you saved. Yeah, I mean, I think ultimately, obviously, it's up to your own personal situation. So one thing I would say about cash is people don't like cash. And there's a good reason for that. You're not earning anything on it. Over time, we know that inflation, of course, erodes the purchasing power of it. So I'm not saying that you should hold cash for the long term, but cash does allow you flexibility and it allows you to take advantage of opportunities. And of those three things that we had on that slide that Shani didn't like, the one in the middle was what I'm doing. And I still see, like, you can still sit there and of course see your account balance going up as the markets keep going up, but accumulating cash gives you opportunities in the future. So I would just think about that. Yeah, I would just think about that. All right, now we're going to go back into the chat, see what's happening here. Okay, so Paul says, Paul must have listened to the podcast on thematic ETFs. So he's saying sell ACDC, so that's that ridiculous battery-operated thematic ETF, Cure, FANG, so these are all these thematic ETFs, and buy, and now he's listing a bunch of quality ETFs, so quality and value. So yeah, potentially if you think the market is overvalued and think particular sectors in the market are overvalued, then that's an opportunity. Okay, so good. Another good question. So if the stock market is overvalued, would it be better to diversify into real assets such as commodities or real estate? Yeah, so what I would say is it'd be really good if inflation takes off. So real assets generally do pretty well in inflationary environments. I'm not saying inflation's taking off, but I'm just saying it's a worry of people right now. Go read about Campbell's Soup in the U.S. and their earnings, and you can see the impact of inflation on some companies. Inflation's a tricky one with the share market, and it's tricky because number one, there are certainly companies you can buy that invest in real estate, invest in commodities, but inflation really has sector by sector different impacts on the economy. So yeah, I mean, it's certainly a possibility, but commodity markets potentially could be overvalued as well, as could real estate, right? So lower interest rates also cause real estate prices to go up. So I know everyone likes to talk about, oh, it's their location and how pretty their bathroom is, but lower interest rates people say that they redid their kitchen and that's why their house is worth so much. But interest rates have a huge impact on real estate as well. So just think about what could happen if interest rates go up. Now, of course, I'm saying this in Australia where, I don't know what, the country could be hit by a meteor and real estate prices would still go up. So seemingly nothing will stop that. Okay, so let's see. An anonymous attendee says, can Morningstar train companies' employees to invest in the market so that the company can invest along Morningstar and use Morningstar advice? Yeah, it's not really what we do. But yeah, they can watch webinars or listen to the podcast. You look like you have something to say about this. No? Wow. She looks terrified now. Scott says, is that a crinkled shirt? Yeah, so I didn't iron my shirt today. It's a pain. I have to take out my ironing board and then, actually iron, and I'm not very good at it. So crinkled, or like, those like out of the 50s sitcoms where like the iron, you can see the iron on the back of the shirt because, wow, Shani's looking at me like I'm crazy. But those things where you see the iron pattern on the back of the shirt, like somebody's left the iron on there for a really long time. You need to watch different television. It's a thing. So yeah, I apologize for my crinkled shirt. I don't know if that means people want to lower their lunch bids, but I do dress up sometimes. All right, we're out of questions. Well, that's exciting. So we can end early. All right, well, thank you guys for joining. If you have any questions, you can email me at mark.lamonica1@morningstar.com. And we'll be back on Tuesday, which will be our 99th webinar. So next Thursday is our 100th webinar. Will's thinking of ideas. The only idea he's come up with is let's shoot it somewhere else. I don't know what that means. But next Thursday will be our 100th webinar, which is exciting. All right, well, thank you guys for joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.